Welcome back to the channel, everyone. Today I want to talk about how Robinhood, TD Ameritrade and a number of other brokers have already begun preparing for the squeeze, aka preparing to take away your buy button. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, you may have seen this pop up if you're still using Robinhood that says instant deposits are now restricted. This is if you recently made a deposit, you'll need to wait for it to settle before you can use the money, typically within 4 to 5 business days. Now, if you are still using Robinhood, I have absolutely no idea what you're doing, and I beg you to please sign up for moomoo using the link in the description below, because moomoo and Futu do not accept payment for order flow. But so previously, Robinhood offered instant deposits or good faith deposits. When you deposit $1,000, Robinhood would give you $1,000 of buying power to go and buy your stocks with. Obviously, these days bank transactions are usually instantaneous, but some bank transactions do still take 2 to 4 business days to actually clear. Therefore, on good faith, Robinhood would still give you this money to trade with, even if it hadn't actually cleared. Now, this is obviously very useful in a retail investor squeeze circumstance because retail investors, like you and I, can deposit more money into our trading platforms, such as Robinhood, to buy more shares of AMC and GameStop to help compound the squeeze. You could say this is a form of FOMO because people are going to want to deposit more money onto their trading platform to buy more shares so that they don't miss out on the actual squeeze. But obviously on the flip side, this actually helps increase the power and the duration of the squeeze because it just means that more retail investors are buying even more shares, therefore causing the price to go even higher. You then end up in this feedback loop of more investors buying more shares, which pushes the price higher, which causes more retail investors to buy more shares, which pushes the price even higher. So by Robinhood limiting and removing those instant deposits, it kind of cuts off that feedback loop because retail investors can't deposit more cash to buy more shares with. Now, interestingly enough, it's not just Robinhood limiting those instant deposits, but it's also TD Ameritrade in their Think or Swim app. Now, obviously, these are those brokers that turned off the buy button back in the January run-up, and this may be a sign they're just about to turn off the buy button again if the squeeze gets too underway. Something else I found very interesting is that TD Ameritrade have just updated their margin requirements. With GameStop, they've now updated it to say that short selling of the stock is no longer allowed at this time. Previously, they just changed the margin requirements when shorting. Back in June, if you wanted to short AMC, you had to have 200 to 300% available margin, and at some points they requested even up to 500% available margin. I think I actually mentioned this in one of my videos the other day, where one of the brokers had just set it to a 500% requirement. Therefore, if you wanted to short $1,000 worth of AMC, you had to have $5,000 of available margin cash in your trading account. But now TD Ameritrade have entirely removed the short selling of GameStop, no matter how much available margin you have in your account. Clearly, TD Ameritrade know that the losses for short sellers is potentially unlimited, especially during a squeeze scenario, and therefore even having 500% available margin may not be enough to cover them. Now again, this third line here is also fairly worrying that says we may implement additional requirements on opening trades on options the day they expire. AKA basically saying that we may not allow you to open trades on options the day that they expire. AKA, TD Ameritrade has just said that we may turn off the buy button if you try and buy some GameStop options. Now again, as I mentioned earlier in the video, if you are still using TD Ameritrade or Robinhood, please sign up for a different broker like moomoo. Now you may say, Tom, why are these brokers like Robinhood and TD Ameritrade already preparing for the squeeze? What information are they looking at that's kind of giving it away and suggesting that AMC and GameStop are about to squeeze? The Real Darkpool tweeted saying there's lots of open interest on the options chain on the $25, the $30 and the $40 strikes. He said this is retail's chance to kick some ass derivative style. Now if we look at the AMC options chain on the Nasdaq website for the 18th of March 2022, we can see tons and tons of open interest at fairly different strike prices. Guys, if you didn't already know, moomoo and Futu have just officially announced that Futu does not accept payment for order flow. and therefore you don't have to worry about your trades going through sketchy dark pools or being given to Citadel. Right now with moomoo you can currently get up to 5 free shares valued up to $3,500 each, and a guaranteed free share worth around $20 on top of that, which is a total of around $17,500 worth of free stocks. All you have to do is sign up to moomoo using the link in the description below and make your first deposit. Moomoo is also a brilliant commission-free trading platform that has tons of technical indicators and advanced charting tools. Moomoo publishes daily short-selling data, position cost distribution, and much more. Moomoo is also incredibly easy to use and incredibly customizable and will help you to trade like a pro. So guys, be sure to sign up to moomoo using the link in the description below for up to $17,500 in free shares. At the $16 strikes, we have an open interest of 20,000 contracts. At the $17, we've got 11,000 contracts. At the $20, we've got 17,000 contracts. $25, about 11,000 contracts. At the 30, we've got 22,000 contracts. And then if we scroll down further to the 50s, we've got 14,000 contracts. Now the options chain is looking a little bit thin between those $30 strikes and the $50 strikes because there isn't a single strike that has over 10,000 contracts. I think what we need here is more interest between the $20 and the $25 strikes and more interest between the $30 and the $50 strikes as well, so we can steadily build that gamma ramp. Now obviously it's pointless if everybody jumps into these $50 strikes while AMC is still trading at $19 or $20 per share, because if that happens, we haven't built that steady gamma ramp. We need to build that steady ramp up in the options chain to continually force those hedgies to hedge for more and more call options by buying more and more AMC shares. For example, right now, these hedgies aren't hedging for the $50 strikes. They're currently hedging for the $20, the $21, and probably the $22 strikes as well. And therefore, if we build more of an open interest at these lower strikes, like $20 to $25, it will force those hedgies to hedge more and more by buying more AMC shares, which will obviously push the price up. I do think this is a positive sign, seeing well over 100,000 open options contracts, but I do think we need significantly more to compound the effects of the squeeze, because back in January 2022, we had over 700,000 contracts. Now obviously due to those ladder attacks that happened throughout January, most of those options contracts did end up out of the money and not in the money, but there was still a substantial number of those options contracts. If we can build up that current open interest in these near to the money options up to 200, 300, 400 or 500,000 contracts, that would cause the hedgies to have to hedge significantly for their current position. Now I do think right now the short hedge funds are currently very scared of both AMC and GameStop, because as Corey says, hey shorts, sorry for your loss. S3 Partners posted saying on Tuesday, short sellers in Tesla, GameStop and AMC lost a combined $2.32 billion. Now obviously losing $2.3 billion on one singular day is a significant amount of money to actually lose, and again it just digs into these short hedge funds' available margin. As I've covered in some of my other videos, the amount of unrealized profits and the amount of available margin that Melvin Capital currently has decreased significantly from June 2021, because tons of their other long positions like Facebook, Snow, Affirm and many more have fallen significantly from their highs, and therefore their unrecognized profits have just been evaporating. Not only have their unrecognized profits been evaporating, but also their outside investment from Citadel and Point72 has also been evaporating, as well as Ken Griffin and Steve Cohen have been withdrawing their investments. And therefore for shorts in total to lose another $2.32 billion on top of what they would have already lost this year on some of their long positions through January, February and March, I imagine they are starting to really feel the pinch. Now interestingly, even though the S&P 500 has been running over the last week, potentially creating additional margin for a number of these hedge funds, it seems like Goldman Sachs is saying that in general, hedge funds are still deleveraging. Now even though over the last week the S&P 500 has been absolutely flying, potentially creating additional margin for these short hedge funds, Goldman Sachs is saying that in general, hedge funds are still deleveraging and selling off their shares and reducing their leverage position. Goldman said that hedge funds have deleveraged for 12 out of the last 16 days. Now, obviously, when a hedge fund borrows money from another hedge fund, that is a process known as leveraging, which is what Citadel does significantly. Citadel only holds around $40 billion of its own money and its investors' money and borrows an additional $200 billion from some of those large banks. Therefore, Citadel has a total portfolio size at the moment of somewhere between $230 and $250 billion. Right now, Citadel is leveraged somewhere around 7 to 1, and therefore for every $1 of Citadel's own money that it holds, it borrows an extra $6 on top of that. And what Goldman Sachs are saying is that over the last 12 out of 16 days, hedge funds in general have been paying back these loans and reducing their leverage position because they know that the market collapse or market crash is still not over, and this is more of a fake bull trap to convince people to buy more shares before bringing the market down even further. And therefore, even though right now the market may be running, over the next few weeks it's likely to continue to fall, and again these short sellers are likely to feel the pinch even more. Now, as you can see here, AMC has well and truly broken that downtrend, and it's looking less and less likely that this is a false breakout and is less and less likely to return into this downtrend. Now, as Pinoy Ape shows, even though we've broken that AMC downtrend, we still haven't yet broken out of this channel that's been going since 2019. And therefore, AMC still has some ways to go before the squeeze is really underway. Even though we did pop above $22 per share for a matter of a few seconds, it was quickly pushed back down below $22 for a false breakout. If I zoom in here, you can see that the wick very quickly passed above this channel before falling back inside the channel, and so far today has been falling slightly further. And again, as I said in my previous videos, I do think that when we break this channel with conviction, that AMC is likely to go much, much higher and return back to $40 and above very, very quickly. Now you may ask, Tom, what's caused the AMC and GameStop run up over the previous few days? And New York Angelo has some ideas what may have caused it. Now, New York Angelo hasn't offered his source for this quote, but it says a top prosecutor, a short seller's confession, and a Columbia professor offer clues to the Department of Justice probe of those short sellers. So it seems maybe one of these short sellers has squealed, or one of these short sellers has informed the SEC of exactly what's going on, as it seems the Department of Justice now have a short seller's confession on record. Guys, be sure to let me know down in the comments below what you think about Robinhood and a number of other brokers preparing for the squeeze, aka preparing to turn off our buy buttons again. And as always, guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.